In today's Growing Your Tree of Prosperity series, I'm going to show retail investors how to think about Singapore Real Estate Investment Trust. Singapore Real Estate Investment Trusts are a very popular investment for old school investors, right? And in this series, we will only be focusing on the 8 real estate investment trusts that are already found in the Straits Times Index. Now, these are extremely conservative investments for investors, and you will see these very popular brand names like Mapletree, CapitaLand, Frasers, and Keppel being represented in this group of 8 REITs. All right, and generally speaking, REITs do fairly well when interest rates are falling. So if you expect interest rates to be falling over the next 6 months to a year, this is not a bad investment to get into, but do note that REITs have just completed a number of years of underperformance when interest rates rose in 2022. All right, so what are the REITs that we are going to discuss today? These are the 8 REITs: the CapitaLand Ascendas REIT, CapitaLand Integrated Commercial Trust, Frasers Logistics and Commercial Trust, Frasers Centrepoint Trust, Mapletree Pan Asian Commercial Trust, Mapletree Industrial Trust, Mapletree Logistics Trust, and finally Keppel DC REIT. All right, that's quite a mouthful, and these are the 8 counters that we're going to talk about next. All right, the first thing we need to understand is that these 8 REITs, while they are positively correlated with each other, they do have a tendency to go up and down together. These correlation numbers are actually quite low compared to the 0.7 to 0.8 that we have between our banks. Essentially, what we're saying after looking at this Pearson correlation heat map is that there is a meaningful reason to pick a specific REIT to do well, all right? Because the underlying properties do well in this particular economic regime. So for example, if we were to pick industrial REITs, it may perform differently from retail REITs. All right, so unlike the banks where all 3 would move together at the same time, it is actually more meaningful to pick REITs based on a favorable sector or geography. Next, let us look at the specific behavior of these 8 REITs. Now, the first point of this slide is that if we were to take our money and divide it into 8 parts and buy these REITs in the STI, we would result in a superior performance as compared to buying an exchange traded fund. All right, so if you focus on the numbers to the left, you find that buying 8 REITs in equal weights for the past 10 years, you would make a very decent 7.85% inclusive of dividends. All right, and the risk is about 15.4, which is not too bad, right? Not too bad. Okay, there is a drawdown of about 35%, which means that there is a worst case scenario in that if you were to actually buy the REITs at a very bad timing, you can potentially see losses of 35%, right? Now, if you were to buy the ETF, I have used the Lion Philippe S REIT ETF, although the numbers do not really change if you were to swap it out with a different exchange traded fund, because it involves a lot of REITs other than these 8 REITs. You expect returns to be much lower at 2.55%, and the risk is actually slightly higher, right? So overall, you have a much lower risk-adjusted return or Sharpe ratio of 0.1624, and the maximum drawdown, if you have bad market timing, the losses are going to be about the same. All right. Now, as we move on and we look at the table onto the right of this slide, you find that for the most part of it, the real estate investment trust in the STI provide a higher current yield than the Lion Philippe S REIT ETF, all right, with the exception of CapitaLand Ascendas REIT and Keppel DC Trust, which are industrial and data center REITs. We do expect dividends to be on average much higher than if you were to buy the S-REIT ETF. So this actually paints a picture that the 8 REITs that have been chosen for listing within the Straits Times Index actually on its own provide very much superior performance, right, compared to various attempts to actually construct some kind of an index or an S-REIT kind of ETF situation. Okay, now, of course, if you were to ask me, can you just pick one REIT that you sort of prefer slightly over the rest? Then my answer would be, well, objectively, if you look at the volatility of these REITs, the lowest volatility that I can find based on my programming code is Mapletree Industrial Trust. It has a standard deviation of 19.04, which is the lowest amongst the 8 REITs. All right, but do note that this position always comes under contention. Sometimes when I run the program, the safest REIT would become Capital Land Ascenda. Sometimes when I run it at some other time, it might become Fraser Centrepoint Trust. All right, but generally speaking, when the slide was being built, there is a slight advantage given to Mapletree Industrial Trust. And of course, if we go back to look at the table previously, you will find that Mapletree Industrial Trust also has the lowest forward price earnings ratio among the group. All right, so I have a slight preference for it, but I still think that if I were to put my money into real estate investment trust, I will be splitting it into 8 parts and investing in all 8 of the REITs in the STI. All right. Now, do note that the use of the price earnings ratio for real estate investment trust is not industrial practice because there is a depreciation from properties. Professionals often use a very similar metric called price to funds from operations, PFFO, but PE ratio is, I would say, a very, very good estimate of PFFO. All right. And of course, Mapletree Industrial Trust is slowly increasing its footprint of data centers, and because it yields above 6% yields, it complements our Singapore banks very well. Okay, but do take note, all this is based on quantitative data, so please do your due diligence and look at what analysts and the newspaper articles have to say about real estate investment trust. But what does it really mean? When we want to look at REIT fundamentals, there are, just like banks, 3 points that I want you guys to look at. The first is net property income. When you are buying a REIT, you are effectively a landlord. So what we are trying to see is that our rental collections go higher and higher quarter after quarter. So we want to see an increasing net property income. In addition to that, in the same newspaper article, you might also want to do some research on rental reversions. When I renew a lease with a higher rental, it means that there are positive rental reversions, and that is a good sign when you're investing in a REIT. The second point when looking at a REIT is we want to know what the gearing is. REITs must have a gearing within 50%. In other words, if you have $1 million worth of property, you can't loan more than $500,000 from a bank to actually sustain your REIT. The lower the gearing, the safer the REIT is, because it means that the loans are less burdensome. And having a low gearing below 40% means that this can reduce the probability of getting a rights issue, which can be very, very punishing for REIT prices, right? So if we should also be looking at the low gearing. On top of it, related to the concept of gearing is interest cover. So we also want to look for a REIT with an interest cover perhaps much higher than another REIT. All right, so you might want to look for a table that can compare these numbers. And finally, since you're actually engaged in properties, it's important to know what kind of properties you own and where they tend to be located. And very generally speaking, healthcare REITs are generally very stable. They tend to do well in most market regimes. Sadly, in Singapore, we have only one very stable, very reliable healthcare REIT called Parkway Life. Okay, but the problem is that it gives a very low dividend. All right. On the other hand, performances of offices tend to be tied to how the economy is doing. So where there is a very high employment rate, the performance of your office properties might not do so well. All right. So at the end of the day, Remember, you're like a landlord, you're owning properties, so make sure you understand what kind of properties you own and which geographical location they are. So this summarizes my presentation on real estate investment trust. It is a very short lesson on how a retail investor can quickly get to grips with REIT investing. All right, so summarizing what I've said earlier on, correlations are lower than banks. So there is some reward that can come from understanding the underlying rental business. All right. Secondly, buying all 8 REITs is superior to buying an exchange traded fund for the past 10 years. You will get better dividends and stronger past 10-year performance when you simply take the amount of money you have, you divide it into 8, and you buy all the REITs that exist within the STI. And finally, there are plenty of analyst reports out there examining the fundamentals of REITs. You might want to put a little bit more effort into examining the NPI and the gearing of the REIT. And always do remember that different kind of properties would result in a different performance, right? A very safe REIT would be a healthcare REIT that is, generally speaking, immune to market cycles. And on the other hand, there are office REITs that tend to do better when there's strong employment, and they tend to do worse when there is a recession. And that's all I have for you. Thank you very much. If you like my content, please subscribe to my channel. That's the best way to help me for now, without paying for anything. If you actually want this to continue, you want to keep it sponsor free, at least sponsorship from financial institutions, you can buy me a coffee by following this link, right? Or if you want to listen a little bit to my life story and figure out how the financial independence and retire early works, then sign up for my course review under Dr. Wealth. Alternatively, just Google ERM intro, take the first link, all right? And I hope to see you in my next video. Thank you very much.